3 minutes on markets and money. I'm your host, Lance Roberts. Just talking a little bit of a market update, kind of looking at where money's rotating here in the markets and what opportunities might be available. We've talked about here recently about the market itself on the broad market side, the S&P 500. We did break above the 50-day moving average after consolidating really for almost a month and a half within a fairly tight range. We did break out to the upside now. As we've talked about here recently, it does set us up for a retest of these all-time highs, and the necessity here will be for the markets to actually break through those old all-time highs if we are indeed going to move higher. Unfortunately, as we talked a little bit about yesterday, the market's already back to very, very overbought conditions, and typically markets don't really have the ability, once they are this overbought, to continue moving higher to any great degree. So a rally back to all-time highs, very possible here, something that we're likely to see, especially when we start looking at the earnings environment, which has been deteriorating, slower earnings growth rates, as well as slower economic growth rates as well. But underneath the surface, there was a little bit of pickup here over the course of the last week as we saw international markets actually pick back up. International's been lagging the domestic markets fairly sharply, really not just for the last year, but over the last several years. But we have seen a pickup here in the international indexes, at least temporarily. Unfortunately, these rallies tend to fail and we get lower lows. So the trend here clearly negative. So again, we don't have any exposure to international markets right now, but if these things do improve, then we'll certainly look at that opportunity. Same thing here for emerging markets. Emerging markets still below their 200-day moving average. Again, a negative trend overall. Really not a reason to own emerging markets at this point. There's really not been a great opportunity to add it to the portfolio to increase rates of return. Being more domestically focused has lowered volatility as well as increased rates of return over the course of the last year in particular. I know there's a lot of people that talk about, well, asset allocation, you got to own a little of everything. Owning international and emerging markets is basically like throwing boat anchors out of a boat and trying to go across a lake. You'll get there. It just slows you down getting to your goal. Sometimes not owning something is just as beneficial as owning it. Mid-cap is actually turned up here a bit better. It looks a whole lot like the S&P 500. It's now within striking distance of its all-time highs. But the one differential here with mid-caps are they are much more economically sensitive to what's going on, and they will be one of the first groups kind of really impacted by slowing rates of growth, economic environments, and mid-caps to some degree don't participate as much in stock share buybacks as large caps. So mid caps here doing okay here, but watch this. They need to really maintain this 50-day moving average if they're going to make a move higher here over the course of the next few weeks. Small caps, on the other hand, still in a negative trend, don't look great. These are the most economically sensitive. This definitely suggests that there's a problem going on in the economy, kind of underneath the surface. National Federation of Independent Small Business Index has softened as here, not surprisingly here with what we're seeing going on in small caps. Again, these companies really don't participate with stock share buybacks, so the downside risk here still outweighs the reward. So again, no exposure here to small caps currently, but we are watching this. If this trend does begin to improve, then we'll look at adding it. That's 3 minutes on Markets and Money today. I'm your host, Lance Roberts. We'll see you next time right here at realinvestmentadvice.com.